In 2024, several prominent partners left venture capital firms in India. Sameer Bridge Verma left Nexus Venture Partners. Anup and Rajiv left Orius Venture Partners. In October 2024, Peak 15, which was earlier called Kae Capital India, India's largest venture capital firm by assets under management, reduced its latest fund size by 16% and actually returned money to investors, citing changes in the Indian venture landscape. So the question is venture capital in India a performing asset class for its investors? For me, in my day job as a venture capital investor, this is a very important question. But even if you are just someone who is curious about startups in India, then it is absolutely critical for our venture capital firms to perform and return money to investors. Else, there will be a complete dearth of private capital in India. When I tried to understand the performance of Indian venture capital firms, I came across an incredible report from the team at Oyster Global, which is called No Ifs about AIFs. And in this report, they cover the performance of Indian venture capital firms and benchmark their returns against the comparable index. Let's get into this week's breakdown. The Breakdown channel is part of the 01 Media Network by Zerodha, and we're extremely grateful for the team at Zerodha to provide us with the resources to bring this research and this high quality production to you. With that, let's get back to the show. Before we begin to understand the performance of a venture capital firm, there are three concepts which you as the viewer needs to quickly understand. The first is XIRR, which stands for Extended Internal Rate of Return. The second is MOIC, Multiple on Invested Capital. And the third concept is staggered cash flows in the world of venture capital. These three concepts are best understood by looking at the cash flow sheet which has been published by Blume Ventures, which is an Indian venture capital firm. In the early years of a venture capital firm, for example in Blume Fund 1, from 2016 to 2017, the fund was actually cash flow negative. What this means is in the first couple of years, as a venture capital firm is making new investments, it is calling on money from its investors. So if you had a $100 million fund, or you've stated that you have a $100 million fund, your investors don't provide you all the money on day zero. They provide you the money on a sequence of payments. Maybe 25 million in the first year, 25 million in the next, so on and so forth. So this is the cash flow stream. And when you look back at the Blume Ventures fund distribution, you will notice that in the latter few years, the fund actually goes from being extremely cash flow negative to extremely cash flow positive. And this is a feature of venture capital firms, not a feature of most other investment firms. Why is it that a venture capital firm has a lot of negative cash flow in the first few years and a lot of positive cash flow in the final few years? Just think about what happens. A venture firm will take the money from its investors, make a series of investments. These investments will take 5 to 7 years to mature, and only once the investment has matured can the venture capital investor generate an exit by selling their shares either through an IPO or through a secondary sale to another investor. And therefore, these positive cash flows are heavily backdated towards the end of the fund. So to summarize, negative cash flows in the start as the investments get made, positive cash flows as the fund matures and investments are exited. The first fund whose performance has been publicly disclosed is Blume Ventures. They have shared the performance of Fund 1 and Fund 1 extension, which they call Fund 1A. So Blume Fund 1 individually delivered a 19.8% XIRR. Blume Fund 1 extension, which is Blume Fund 1A, delivered a 31% XIRR. And the combination of these two funds, since they broadly had the same set of investors, delivered more than 21% XIRR. Now for comparison, some of the aggressive small cap mutual funds over the course of 10 years have delivered somewhere from 19 to 26% XIRR. XIRR. Blume benchmarked its performance against the Nippon small cap mutual fund, which arguably outperformed everyone with more than a 25% XIRR. In this case, of course, small cap mutual funds beat Blume Fund 1, but regardless of what you say, a 21% XIRR maintained over 10 to 11 years is extremely commendable performance. Next up, we will look at the performance of Kae Capital. Kae Capital was founded by Sasha Mirchandani. Kae Capital Fund 1 started in 2012 and to date has generated an IRR of 22% for its investors, which actually beats the comparable small cap index in this window. Obviously is beaten by some mutual funds, but it's very incredible to see this performance and how has Kae Capital managed to generate such great performance in Fund 1. The answer lies in 3 hits that they've managed to deliver, and these 3 hits are 1mg, which got acquired by Tata Group, Porter, which is a business I'm sure you have seen on the roads with their blue signboards on trucks and tempos, and Healthcart, which maybe is a business that you have ordered medicines from. The final fund for which we have more detailed information is India Quotient. India Quotient is a firm based out of Bangalore. Their first fund was started in 2013 and they have returned an impressive 7 times the money that their investors put in over a short span of 9 years. And what has driven this impressive return is 2 hits. The first is Lending Cart, a lending business focused on small and medium scale businesses, and the second is Sugar Cosmetics, a company which I'm sure you've heard of because of Shark Tank. The team at India Quotient has been able to deliver an impressive 22% gross IRR. When I tried to understand the performance of Indian venture capital firms, I came across an incredible report from the team at Oyster Global, which is called No Ifs about AIFs. And in this report, they cover the performance of Indian venture capital firms and benchmark their returns against the comparable index. I'd like to give a shout out to Himanshu Periwal, who is the Chief Operating Officer at Oyster Global. He was very kind to spend time with me to fact check some of the statements that we were going to make in today's video. What I personally liked about the Oyster Global report is that this data comes directly from the source. So Oyster Global partnered with CRISIL, the rating agency, and as per SEBI regulations, every AIF scheme are required by law under SEBI's rules to share quarterly updates on their positions with SEBI. This data is shared by SEBI with CRISIL. Therefore, you can trust that the figures coming out of this report are accurate. Today, you as an investor can get all possible data on every mutual fund out there by simply opening an app like Zerodha, running a comparison. You can see the 1 year, 3 year, 5 year performance. You can find information about the fund manager. It's an extremely high level of transparency and information that is available at the investor's fingertips. But this is not true about private markets. The first takeaway from the Oyster Global report is that there is more domestic participation in Indian venture capital and more institutional participation in Indian venture capital. And what are the numbers? The institutional contribution to venture capital funds has gone up from 60% to 66%. This is a 6% increase over a 3-year window. The Indian resident contribution has increased from 73% to 76.5%. Why is this important? For the Indian venture capital market to mature, it is very important for Indian resident investors and Indian resident institutions to be contributing to investing in our own companies. The next takeaway is that early stage venture capital firms have outperformed the comparable index. Now, this is a very bold statement to make based on a sample size of 86 venture capital firms that have been around for the last 10 years and have reported their numbers to SEBI. What we have is the IRR in early stage AIFs is 26.86%. This is in comparison to 22.57%, which is what the BSE 250 small cap comparable index has returned. This means that on a gross basis, the early stage AIFs have outperformed the public comparable by about 4.29%. Next, let's understand what is the comparable index. And again, late stage AIFs have outperformed the public market market peer. So once again, let's first understand what Oyster Global means by late stage AIFs and what they mean by comparable index performance. For Oyster Global, late stage AIFs are those Cat 1 and Cat 2 AIFs that deploy 100% of their money into later stage private market deals. Per the Oyster Global data, there is a sample of 30 schemes that have operated for the last 10 years, and the data that we have is that their IRR is 23.61%, and this represents almost a 5.97% alpha or outperformance relative to the comparable index. Now there is one bonus takeaway that we should cover, which is how does the average venture capital firm perform? As per the data in the Oyster Global report, the average fund delivers 2x return to its investors over the course of 10 years. The top 50% of funds deliver a 2.7x return to their investors. The top 25% deliver a 3.18x return to investors. And because this first generation of Indian venture funds have generated not just paper profits, but actual cash returns to their investors, there is now a frenzy for India's ultra high net worth and family office clientele to deploy their money into private markets. And let's quickly recap how India's fascination with private markets is growing every day more and more. The legendary public market investor Madhu Kela has his own alternatives or venture capital fund called Singularity Growth Fund. It has a corpus of 2,100 crore, and he's even managed to rope in Carrot Lane founder Mithun Sacheti to be one of the members of the investment team and part of their investment committee. At the same time, another public market investing legend, Ashish Kacholia, is himself writing significantly large checks into early stage companies. Some of the recent examples are 16 crore into Early Sign, 50 crore into Fermon IC Design, a semiconductor company, and he co-led an 80 crore round in Investor AI. The demand for private market investing from ultra high net worth clients is so high today that wealth management platforms like Deserve have launched their own AIF opportunities to allow their clients to invest in startups. Deserve has its own fund called Deserve Innovation Fund, which co-invests with some of the well-known investors in startups. And 361 Wealth Management went and acquired Mumbai Angels, which was a platform for angel investing. The acquisition of Mumbai Angels happened in January 2023, and 361 paid 45 crore to acquire Mumbai Angels. We also know that some of the larger and well-established homegrown brands in venture capital are now starting to raise a significant amount of their corpus from domestic investors. The most recent Blume Ventures fund, which is Fund 4, got about 40% of its 2,500 crore rupee corpus from domestic investors. And if you've been following the news lately, you would have noticed that pre-IPO is another area where Indian domestic investors are going absolutely crazy. Swiggy was a great example. Zepto managed to raise $350 million solely from Indian ultra high net worths and family offices so that it could come closer to the 50% domestic ownership requirement in compliance with e-commerce norms for FDI. The appetite for private market investing in India right now is at an all-time high, especially as some investors had booked their profits over the course of August to November and are now sitting on large war chests, which they are slowly deploying into public markets but are actively exploring diversification into private markets for. The first thing for me to highlight is that it is extremely hard to get access to high quality information about private market performance in India. And in this regard, the team at Oyster Global and CRISIL have done a fantastic job making this data available in a format that can be understood by all of us today. At the same time, it's very important for me to say that the IRR figures that are shared in the Oyster Global report is a combination of realized and unrealized IRR. Now, this is extremely important important because in the public market investing world, where a lot of you, our viewers, may have your money, the difference between unrealized and realized profit is almost minimal because you can trade your shares or you can exit your position very easily unless you've bought an extremely illiquid stock. However, in the world of venture capital and private equity, the divergence between unrealized and realized returns can actually be quite large, even very late into a company life cycle. At the start of this video, we commented on how some investors have taken a write-off finally in their Byju's investment. The way private market investors work is once a quarter, they mark their positions and report this to their investors. We had said that in India, AIFs are required to submit audited financials to the SEBI. The same way, all venture capital investors, regardless of whether they are domiciled in India or overseas, provide a quarterly position statement to their investors. And therefore, this unrealized return also includes cases where a company has raised a follow-on round of financing, but the venture capital firm has not had the chance to sell even a part of its position. So one of the big criticisms of venture capital performance in India is that there is a lot of paper gain, but not a lot of cash returns. Now, we've also seen how investors like Blume, Kae Capital and India Quotient, whom we covered at the start of this video, have delivered legit cash returns to their investors. However, in the Oyster Global report, a lot of the IRR figures include unrealized returns. Now, my own experience as a venture capital investor and my conversation with Himanshu from Oyster Global have suggested that if you look at the spread or the difference between the unrealized and the realized return of most venture capital funds, they tend to be quite narrow. And the reason for this is a typical fund manager tries to be as conservative as possible with taking markups and is as preemptive as possible with taking markdowns. And the reason for this is if there is a flag from an auditor saying that a fund manager is taking on markups unnecessarily, it invites scrutiny from the SEBI. And also, if you take markups very aggressively and are then required to mark down your positions, as a fund manager, you have a very difficult conversation to have with your investors. While some businesses can be built completely bootstrapped, there is an entire set of businesses that can only be built if there is some form of capital that is available for capex, for R&D, or for growth. And this is where venture capital and private equity become extremely important for a nascent startup ecosystem like the one we have in India. Now, you will have entrepreneurs like Paras who sold Wingify for over $200 million. Paras has not raised a single dollar of outside capital for his business. My own mother is in her 13th year of running her company without a single dollar of external money. If venture capital as an asset class doesn't perform in India, then that source of funding would be completely dried up. And this is also why venture capital as an asset class is more suitable to ultra high net worth or family office clients who have a much larger corpus and can deploy a small part of their money into this asset class, which is illiquid, and that means you cannot withdraw the money out. Typical investor in a venture capital firm is allocating no more than 5 to 10% of their overall corpus to this asset class. On average, it takes 6 years for a venture capital firm to return the original corpus that it has taken from its investors. So to summarize, do Indian venture capital firms beat mutual funds? In some cases, yes, they do. In some cases, they don't. But the misconception that Indian venture capital is not performing as an asset class is completely not true. And I do hope that with this breakdown, your understanding of Indian venture capital and its performance has improved. Please do hit the like button below, do subscribe and share this breakdown. Thank you.